Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 May-June Paper 4-2 question number 1. This is the structured paper 4, which consists of 2 questions. Each of them will be of 25 marks and the total time limit for this paper is 1 hour. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 1 within 30 minutes. So without any further delay, let's get started. PM PLC is a manufacturing company. Its sales budget for 2025 includes the following. So we have been given the sales units for the months of April, May, June, July, and August. It is a policy of the company that the inventory of finished goods at the end of each month should equal 20% of the expected sales in the coming month. So it just means that the closing inventory for each month will be equal to 20% of the sales in the next month. Alright, let's take a look at our first question. We need to prepare the production budget in units for each of the months April, May, June, and July 2025. Alright, so we have April, May, June, and July. And we need to figure out the number of units to be produced within each of these 4 months. The formula is quite simple. We always start with the sales units. We then add the closing inventory. And subtract the opening inventory. And this will give us the production units. The first thing we can do is write down the sales units that was given within our insert paper. So that will be 1000 for the month of April, 1200 for May, 1500 for June, and 1300 for July. So 1000, 1200, 1500, and 1300. Then for the closing inventory, we've already written down the formula that it will be 20% of the sales in the next month. So if we are talking about closing inventory in the month of April, that will be 20% of the sales of May. So that's 20% of 1200, which will result in 240. Let's write it down. Now we repeat the same process for the remaining 3 months. For the closing inventory in the month of May, that will be 20% of the sales in June, which is 20% of 1500, which results in 300. Then for the month of June, that will be 20% of the sales in the month of July, so 20% times 1300, which results in 260. And for the month of July, that will be 20% of the sales in August, so 20% times 1100, which results in 220. Now for the opening inventory, always remember that the closing inventory of this month will act as the opening inventory for the next month. So April's closing inventory will be May's opening inventory. Similarly, May's closing inventory will be June's opening inventory. And June's closing inventory will be July's opening inventory. Then for the month of April, the opening inventory will be equivalent to the closing inventory for the month prior April. So that will be the closing inventory for the month of March. Now, since we need to calculate the closing inventory for the month of March, that will be equivalent to 20% of the sales in the month of April. So 20% times 1000, which results in 200. Let's write it down. Now we can easily calculate the production units. That will be 1000 plus 240 minus 200 for the month of April, which results in 1040. For the month of May, that will be 1200 plus 300 minus 240, which results in 1260. For the month of June, that will be 1500 plus 260 minus 300, which results in 1460. And for the month of July, that will be 1300 plus 220 minus 260, which results in 1260. That will be all for the first part. Let's move towards the next part. we have been given additional information. The budgeted cost structure of each unit is as follows. So these are the per unit values. For direct materials, each unit will cost $25, and these are purchased on credit in the month of production. Alright, 1/5, which is 20%, will be paid for in the month following purchase after a 5% discount. So in the month following purchase, we will be paying 20% of the total purchase after a 5% discount. So 1 minus 5% as well, or we can just write it down as 95%. Since 5% will be the discount value, only the remaining 95% will have to be paid in the month following purchase. Then another 1/5, which is again 20%, is paid for in the month following purchase but without any discount. So again, this is also in the month following purchase, but we will be paying only 20% of the purchase value, and there will be no discount in this case. Then the remainder, which is 60%, will be paid for in the second month after purchase. Again, there is no discount. So in the second month after purchase, we'll be paying 60% of the total purchase amount. Alright, now for direct labor, each unit will require $30, and this is all paid in the month of production itself. Then other costs are $40 per unit, and these are all paid in the month after production, with the exception of a $4 per unit charge for depreciation, because depreciation is a non-cash expense that will not have to be paid. So the amount that will be paid in the month after production is 40 minus 4, which is 36. And remember, this is the per unit value. Let's take a look at our question. We now have to prepare an extract from the cash budget for each of the months June and July 2025 in order to show the payments related to production. Alright, so we're only talking about production in this case. So we have the months of June and July. Okay, we can start with the direct materials, and let us start with the payment that will be made in the month following purchase. So payment in the month following purchase. So it means that in the month of June, we'll be paying for previous month's purchase of the direct materials. So we have to take a look at the production units in the month before June from part A. Let's take a look. So before June was May, and within May we have to produce 1260 units. Now for 1260 units, we need to pay 25 per unit, right? So 1260 times 25 will have to be paid. And this is only the direct materials required for in the month of May. So this gives us a total of 31,500, out of which we will only be paying 20% after allowing a 5% discount in the month following purchase. Let's write it down. And this is with discount. Okay, so the total amount was 31,500. We're only paying 20%, and that is after allowing a 5% discount. Now this results in the value of 5,985. Now let us also write the payment in the month following purchase, but this one is without discount. This is without discount. Let's take a look above. Without discount was just 20% of the purchase value. So that is just going to be 31,500, which is the total purchase value, times 20%, which results in the value of 6,300. Now we will repeat the same process for the month of July. Since we are talking about payment in the month following purchase, for the month of July, we will be referring to the purchase that will have to be made for the production in the month of June. So we need to refer to the number of units that will be produced in June first. Let's take a look above. So within June, we will be producing 1,460 units. Each of these units will require 25 for the direct material. This results in the value of 36,500. Now let us make our calculations for the payments. For the discount part, that will be 36,500 times 20% times 1 minus 5%, which results in the value of 6,935. Now for the without discount part, that will be 36,500 times 20%. which results in the value of 7,300. Okay, now let's talk about the payment in the second month following purchase. For the month of June, we will have to refer to the production units 2 months before June. That will be for the month of April. Let's take a look above. Within April, we will be producing 1040 units. Each of these units will require 25 as the direct material. This results in a total of 26,000. And the payment in the second month after purchase is 60% of the total value. So the calculation here will be 26,000 times 60%. This results in the value of 15,600. Now we repeat the same process for the month of July. Again, we need to refer to the production units 2 months before July. That will be the month of May. And within May, we've already made the calculation that the total purchase value is 31,500. Now in the month of July, we'll be paying 60% of that amount. Let's calculate the value. That will be 31,500 times 60%, which results in the value of 18,900. Now this is for the direct material. Let's take a look at our direct labor. For the direct labor value, all will be paid in the month of production, and each unit will require 30 for the direct labor. So since we are preparing for the months of June and July, we need to refer to their respective production units. For the month of June, that will be 1460 times 30, which results in the value of 43,800. And for the month of July, that will be 1260 times 30, which results in the value of 37,800. Let's write it down. So 43,800 and 37,800. Then we also have other costs. We've already excluded the depreciation from it, and after the exclusion of depreciation, we need to pay 36 per unit. And these are all paid in the month after production. So in the month of June, we need to refer to the number of units produced in the previous month, which is the month of May. So for May, the other cost will be 1260 times 36, which results in the value of 45,360. This will be included in the month of June, and within the month of July, we need to take a look at the number of units in the previous month, which is the month of June. So the other cost for June will be 1460 times 36, which results in the value of 52,560. Let's include these amounts. So for the month of June, we calculated it to be 45,360, and for the month of July, it was 52,560. That is all for the payments related to production. So we can calculate the total production payments. Alright. For the month of June, that will be 5,985 plus 6,300 plus 15,600 plus 43,800 plus 45,360, which results in 117,045. We repeat the same process for the month of July. That will be 6,935 plus 7,300 plus 18,900 plus 37,800 plus 52,560, which results in 123,495. That is all for the second part. Let's move towards the next one. And we have been given the working section. So you need to show all of these workings along with the workings for our direct labor as well as the other cost within that particular box so that you get your markings correctly. Now we have been given additional information. The company usually makes all its sales on a cash basis for a selling price of 150 per unit. It expects to operate with a bank overdraft throughout 2025. So for all months in 2025, we're going to have a negative bank balance at the end of each month. Then the company has received an order from a prospective new customer who is based overseas. This order is for 900 units to be supplied in June 2025. The customer is prepared to pay 156 per unit, paying in 6 equal monthly installments starting in August 2025. Alright, we now need to calculate the change in the expected bank overdraft at the end of each of the months June, July and August 2025 if the order was accepted. Assume that all the extra production would take place in the month in which the units are supplied. Okay, so we need to assume that we will be producing the 900 units within the month of June itself, when it is expected to be supplied to this prospective new customer. Now for the change in the month of June, July and August, we first need to talk about the production payments that will have to be made. Then the customer is to pay in 6 equal monthly installments starting in August 2025. So we also need to consider the payment to be received within the month of August. Let's write it down. I think we can prepare 3 different columns for the 3 months. So June, July and August. Let us first talk about the direct materials. So in the month following purchase, let us talk about the with discount value. We know that each unit requires $25 of direct material. So the total direct material in this case will be 900 times 25. This results in the value of 22,500. And remember that we need to produce these 900 units in the month of June, which means that the payment will be made for in the month of July. So the payment to be made within July with discount of 5% will be 22,500 times 20% times 1 minus 5%. Which results in the value of 4,275. This is a payment, so let's write it down in a bracket. Now let's talk about the payment in the month following purchase without discount. So in the month following purchase, this is without discount. So it will just be the total amount of 22,500 times 20% without any discount. This results in the value of 4,500, which will again be paid for in the month of July. Then we have the second month following purchase. So in the second month following purchase, we'll be paying 60% of the total amount. So 22,500 times 60%, which results in the value of 13,500. And since the production is to take place in the month of June, the second month following purchase will be August. So 13,500 will be paid in August. That is all for the direct material. Now let's talk about the direct labor. Direct labor will cost 30 per unit, and it will be paid for in the month of production. So we have 900 units and 30 per unit. So the total direct labor cost will be 27,000, and it will be paid in the month of June itself. So 27,000, this is a payment. Then we also have the other cost, and we excluded the depreciation for other costs, which was 36, and it will be paid in the month after production. So this will also be paid in the month of July. And the amount for the cost will be 900 times 36, which is 32,400. Let's write it down. And finally, there will be a receipt in the month of August. So receipt from customer. And in this case, the customer is prepared to pay 156 per unit. So the total revenue should be 900 times 156, which results in 140,400. And this will be paid in 6 equal monthly installments. So one installment will be of 140,400 divided by 6, which results in 23,400. This will be received firstly in the month of August. Let's write it down. So 23,400. All right. Now we can get the change in net cash flow. Let's calculate it. For the month of June, it will only be negative 27,000. For the month of July, that will be negative 4,275 plus negative 4,500 plus negative 32,400, which results in negative 41,175. And for the month of August, that will be negative 13,500 plus 23,400, which results in 9,900. Now we need to add it to the change in opening bank overdraft, which will then give us the change in closing bank overdraft. Okay, for the month of June, there will be no change in the opening bank overdraft, so that is just going to be 0, which means that the change in closing bank overdraft is going to be negative 27,000 plus 0, which is negative 27,000. Then this month's closing change will act as the next month's opening change. So change in the opening bank overdraft for the month of July is negative 27,000. Which means that change in the closing bank overdraft will be negative 41,175 plus negative 27,000, which results in negative 68,175. Then this acts as the change in opening bank overdraft for the month of August. And the closing bank overdraft will have the change of positive 9,900 plus negative 68,175, which results in the value of negative 58,275. And the question has asked to calculate the change in the expected bank overdraft at the end of each of the months June, July and August, which is right here. So it just means that for the month of June, the bank overdraft will further decrease by 27,000. For the month of July, it will further decrease by 68,175. And for the month of August, it will further decrease by 58,275. That is all for the third part. Let's move towards the next one. We now need to advise the directors whether or not the company should accept the order. We need to justify our answer. All right. This is of 7 marks, which means that 1 mark will be reserved, for our decision. The 3 marks should be for the advantages if the company should accept the order and the disadvantages of accepting the order. Let's start with the advantages. We can first compare our selling prices, because normally the selling price is 150 per unit, whereas in this case the selling price is 156. It means that it would be more profitable than the usual sales. Let's write it down. It would be more profitable than the usual sales. Secondly, since we are now considering accepting an order of a customer who is based overseas, it means that the company will be able to increase market share as well as enter the overseas market. Let's write it down. It would increase market share by entering overseas market. Then another advantage could be that the customer could have repeat orders in the future. Let's write it down. There might be repeat orders in the future. Now let's consider the disadvantages. The first thing is about the credit payment, because currently we are only allowing cash sales, but in this case we are considering the payment in 6 equal monthly installments, which will begin 2 months after the sales takes place. So if the regular customers get to know about this, they might also request credit. Let's write it down. Regular customers may also request credit. Then, since we are considering producing additional 900 units, we also need to consider the capacity in the factory. There might not be enough capacity there. Let's write it down. There might not be enough capacity in the factory. The next thing is that in order to produce additional 900 units, we would need additional labor as well as materials, which might not be available. Let's write it down. Additional labor and materials may not be available. Now, based on these factors, we need to make a final decision. So personally, I would suggest the directors to not accept the order because we are providing a longer credit period, which means that there is a greater risk of not being paid. Let's write it down. The directors should not accept the order because of the longer credit period, which increases the risk of not being paid. That is all for this part, as well as this entire question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.